Welcome back to the Deep Dive. We often cover companies that sit at the very center of these huge global trends.
Right.
But sometimes a company just generates a number so enormous, so utterly astonishing that the story demands our attention all on its own.
And that's exactly what we have today.
Today, we are deep diving into Samsung Electronics, the true giant of the semiconductor world, trading under 0.05930 KO.
It is a phenomenal story. I mean, this is a corporate titan finally shaking off a very, very bad couple of years.
A brutal downturn.
Absolutely. Samsung has just hit what every analyst in Seoul and, New York is calling a decisive inflection point. They spent 2023 and most of 2024 struggling through that memory downturn, and it was compounded by a very public, very painful lag in the hottest market segment.
High bandwidth memory, HBM.
Exactly, the AI-centric memory that everyone needs.
They were the undisputed king, and then suddenly they just looked slow.
They did. But this isn't just a recovery, as you said, it's something more.
It's a renaissance. The number we have to anchor this entire discussion around is Samsung's preliminary operating profit guidance for the fourth quarter of 2025. It's approximately 20 trillion Korean won.
20 trillion KRW. I mean, just to give you some perspective, that's about 13.8 billion US dollars.
In a single quarter.
In one quarter of operating profit. That figure is the definitive siren call that the downturn is over and the new supercycle is here.
And it's not just the size, it's the trajectory. That 20 trillion won figure, it triples their performance from the prior year.
An incredible jump.
But crucially, it actually eclipses the historical peak they set way back in the legendary 2018 supercycle.
Which everyone thought was the high watermark for profitability. This is a new era.
So this isn't just a return to normal.
No, not at all. This guidance, which they released in January 2026, it's not just a sign of market recovery. The sources call it the definitive quantitative signal that their operational turnaround has actually worked.
All the skepticism is just melting away.
It has to. The numbers are too big to ignore.
So our mission for you, the listener, today is to give you the shortcut. We need to explain why this massive shift happened so quickly and what it means. We're tracing three big interconnected narratives.
Okay.
First, the powerful structural AI-driven memory supercycle. Second, the really painstaking technical catch-up they had to execute in HBM and their foundry business. And third, the slower but critical evolution of their corporate governance.
Right. And if you look at the source analysis, the key conclusion is that the company is a value catch-up opportunity.
What does that mean exactly?
It means the market, the analysts, the traders, they've absolutely priced in the cyclical recovery in commodity memory. That's what gets you to 20 trillion won.
Got it.
But what the market hasn't priced in yet is the long-term success of the turnaround in those AI-facing segments. If they can really win the HBM and foundry wars, there is still significant upside. That's the optionality we're really exploring today.
Okay, so let's unpack this with a big picture first. We need to get a handle on the global semiconductor landscape. We keep hearing supercycle, but that term gets thrown around a lot.
It does. Often leads to disappointment.
Exactly. Why should we believe that this cycle is structurally different from the predictable, painful boom and bust pattern we've seen in the past?
That is the right question to ask because historically these cycles were entirely reliant on you and me, on consumer demand.
Right. New PCs, new smartphones.
Exactly. Memory cycles used to rise and fall based on those replacement cycles, and that demand was elastic. If prices got too high, people just waited. They'd wait 6 months to buy a new phone.
Which led to that classic inventory overshoot, then a painful correction where companies were selling chips below cost.
Precisely. The new model is fundamentally different, and this is the core insight. It's not cyclical. It's secular growth. It's driven by the massive and, crucially, price inelastic capital expenditure wars of the hyperscalers.
Amazon, Google, Microsoft, Meta.
That handful of giants. They are locked in an existential race to build generative AI infrastructure, the foundation for training LLMs like GPT-5 and Gemini Ultra.
And their spending doesn't slow down if the price of a standard memory module goes up 50%.
No. The race is too important. They can't afford to fall behind.
That structural shift in demand from the consumer to the cloud provider is just profound. And this is where high bandwidth memory, HBM, has gone from this niche exotic component to the absolute strategic choke point.
It really is. The sources say it's now the single most critical bottleneck in the entire AI hardware stack.
Why? What does it actually do?
It dictates how fast and how power efficiently an AI accelerator chip like an NVIDIA GPU can operate. If you don't have enough fast close HBM, your multi-thousand-dollar AI processor just sits there, idle, bottlenecked,
Just waiting for data.
waiting for data and generating a ton of excess heat. The demand is staggering, and the physics behind why it's a bottleneck explains why the entire commodity memory market is being pulled up along with it.
Okay, explain that physical constraint for us, because I think understanding how HBM is made is key to all of this.
Absolutely. Manufacturing HBM is inherently capacity intensive. It's all about vertical stacking. Unlike a standard DDR5 stick where the memory dies lie flat, HBM requires you to stack up to 12 or even 16 DRAM layers vertically.
And you connect them with those through silicon vias, the TSVs?
Exactly. Microscopic holes drilled through the silicon. This whole advanced process consumes approximately 3 times the wafer capacity of a standard DDR5 module, the same data storage capacity.
3 times the wafer space.
Yeah.
I mean, if you're running a clean room, which is the most expensive real estate on the planet, and you have finite capacity,
And HBM sells for 5 to 10 times the price and margin of standard DDR5.
the business calculus is immediate. It's unavoidable.
It leads directly to the core market dynamic right now: capacity cannibalization. Samsung, SK Hynix, and Micron are all aggressively reallocating their limited cleanroom space. They're diverting it from making standard DRAM toward this high-margin HBM. They have to. The hyperscalers are guaranteeing the volumes.
And the inevitable result of that reallocation is that you artificially constrain the commodity memory market.
Exact.
If your production lines are busy making these complex HBM stacks, you're just not making enough standard DDR5 for servers or NAND flash for phones.
Precisely. This is what the analysis calls the double-engine growth driver for Samsung. They're getting expanding volumes and huge margins in the HBM segment, that's the AI engine,
Right.
and they are simultaneously benefiting from soaring average selling prices in the constrained commodity segment, that's the spillover engine. They are getting paid handsomely coming and going.
And the data point here just validates the entire story. We're not talking about small price increases.
No.
The forces indicate that conventional commodity DRAM contract prices rose by approximately 40 to 50%.
Quarter over quarter. In Q4 2025,
That's an explosive, unprecedented price increase driven entirely by this manufacturing squeeze.
to put that in context, that is a rate of price appreciation you usually only see after, like, a major earthquake or a factory fire, an unplanned disruption.
But here, the disruption is controlled and intentional.
Exactly. It's driven by that insatiable, price-insensitive demand for AI. The AI rush is effectively starving the traditional memory market, and Samsung, as the largest capacity holder, is the massive primary beneficiary. That's the foundation for that 20 trillion won profit.
Here's where we connect that macro environment to the micro-financial details. Let's break down that 20 trillion won number and look under the hood. See exactly how the money moved in Q4.
Okay, so starting at the top line, the revenue. Samsung projected consolidated sales of about 93 trillion KRW.
Which is a huge number.
It's monumental. It's the first time quarterly sales have ever breached the 90 trillion won threshold. And that's all thanks to the pricing power we just discussed in their semiconductor division.
So sales volume was strong, but pricing provided that massive jump. But the profitability, that's the real shocker. That 20 trillion won profit is a 208% increase year over year.
Which is huge, but the impressive part is the operational leverage.
Explain that for us.
So while total revenue grew by about 17 trillion won year over year, profit grew by 13.5 trillion. This implies that the vast majority of that incremental revenue, the money from the price hikes, had an exceptionally high margin.
Because the fixed costs of running the fab are already covered.
Exactly. Every extra dollar from a price increase goes almost directly to the bottom line. It's textbook supercycle dynamics.
And they beat the consensus estimates, too. The market was expecting around 18 trillion won.
They beat by about 11%. And there's a crucial accounting detail that explains that extra 2 trillion won surprise.
Okay.
It's the reversal of inventory valuation losses.
Right. This is a powerful but temporary booster effect.
It is. During the painful downturn in 2023 and 2024, Samsung was legally forced to write down the paper value of its massive memory inventory to match the depressed market prices.
So they had to pretend the chips they made for $50 were only worth $30 on their books, taking a paper loss.
Precisely. But as prices rebounded so sharply in late 2025, those write-downs were legally reversed and added back into the operating profit.
Like an instant, massive accounting boost.
It is. That reversal provided a significant one-time gain, contributing heavily to the surprise beat over the analyst consensus, the cycle turning back on itself.
So even with all the AI headlines, the massive volume of that Q4 profit was still underpinned by the classic cash generators.
Commodity memory. Let's start with DRAM.
DRAM was the hero.
It really was. And Samsung proved its capacity dominance here. With prices jumping 40 to 50%, they swung their production lines back to high utilization rates faster than their competitors.
Which allowed them to reclaim the #1 global DRAM market share spot in Q3 2025.
They did. And they solidified that lead in Q4. And it wasn't just volume, it was about the profitable product mix. Data centers are still upgrading their general-purpose servers.
Right, not everything is an AI accelerator.
Exactly. And the sources highlighted explosive demand for high-density DDR5 server modules. We're talking 128 gigabyte plus parts. These are massive, high-margin components that command a significant premium.
And we can't forget NAND flash. That market was in a brutal slump.
Far worse than DRAM. Chronic oversupply. But it has finally turned the corner. Prices rose by a very respectable 20 to 30% in Q4, signaling a full recovery.
What drove the NAND recovery specifically?
Again, it was AI infrastructure spending. It was the urgent demand for high-capacity enterprise SSDs, or ESSDs.
For what? The AI data lakes?
Exactly, for storing the massive amounts of data needed for training these huge models. And Samsung's strategic focus on QLC quad-level cell ESSDs was key.
Okay, we need to clarify QLC for a second. We usually hear about TLC. What's the difference?
Excellent point. QLC, flash stores 4 bits of data per cell compared to 3 for TLC. The advantage is massive density. You get way more storage capacity per wafer.
And the trade-off is endurance. It can't be rewritten as many times.
Correct. But for AI data lakes, which are mostly write once, read many environments, QLC is perfect. Samsung pushing these QLC ESSDs meant they were selling the most capacity-rich storage at the lowest cost per terabyte.
Which is exactly what the hyperscalers need.
And it moved their entire NAND division definitively back into profitability after quarters of major losses.
So profits are just surging. Which brings us to financial discipline. Let's talk about CapEx, because that's where the free cash flow story gets really exciting.
This is a critical point that differentiates this cycle from 2018. In 2025, Samsung's total capital expenditure was projected at 47.4 trillion won.
Which is a decrease from 2024.
A significant decrease from the 53.6 trillion they spent in 2024.
Wait, they're moderating spending just as the supercycle is starting? That seems counterintuitive. Shouldn't they be pouring every penny into new fabs?
That's the strategic brilliance of their prior move. They were aggressively countercyclical. They kept spending heavily in 2024 when their competitors were slashing budgets.
So they already built the capacity they needed.
They did. They have the clean room space available, so they can afford to moderate overall spending now while harvesting the profits. They're shifting CapEx away from building new shells and into highly advanced R&D.
So the total number is lower, but the spending is more focused.
Precisely. Less on buildings, more on cutting-edge equipment for HBM and 2nm production.
And the financial result of that?
Spectacular expected free cash flow. With profits surging and CapEx stabilizing, FCF generation is expected to be truly substantial in 2026, potentially exceeding 30 to 40 trillion KRW.
That is a massive cash pile.
A strategic cash pile. It gives them options, powers R&D, and fuels that entire shareholder return discussion we'll get to later.
We've established that the money is flowing today. It's driven by commodity memory, pricing, smart CapEx. But the core of the long-term investment thesis, it relies on Samsung proving it can win the technological wars of the AI era.
Right. If they fail here, they're just another cyclical memory stock.
This means focusing on 2 key high-stakes battlegrounds: high bandwidth memory, where they lost ground, and the foundry business, which has just been a money pit.
This is the real story of that value catch-up opportunity. And let's start with HBM. It's fundamentally about closing the gap with SK Hynix.
And the challenge in 2024 was, it was devastatingly real and public. They struggled with thermal management in their HBM3E products. Why did they struggle so badly, given their dominance in memory?
It was a complex packaging design problem. When you stack 12 layers of memory, heat becomes the critical factor. Samsung's initial design reportedly had issues with the consistency of the underfill material used between the dies,
Okay.
and inconsistent stack height uniformity. This created hotspots, which led to premature failure in those rigorous, high-power AI environments.
So they failed the qualification test with NVIDIA.
They did, and that failure was a massive strategic blow. It allowed SK Hynix to dominate the early supply for NVIDIA's market-leading GPUs.
But the engineering teams executed a pretty effective turnaround.
A highly effective one. They focused on a major product redesign, a new approach to thermal dissipation, and their redesigned 12-layer HBM3E, the HBM3E12H, it passed NVIDIA's stringent qualification tests in September 2025.
That qualification was the critical license to operate. It proved the issues were solvable.
It did, and that validation opened doors everywhere else. Crucially, Samsung reportedly secured dominant market share with other hyperscalers building their own AI chips.
Like Google.
The analysis points to Samsung supplying over 60% of Google's HBM requirements for its TPU processors and winning huge orders from AMD for their MI300 and upcoming MI350 series.
So they've successfully diversified away from total reliance on NVIDIA.
They have. But the real high-stakes bet is the next generation. HBM4. This is where the battle for technological superiority will be fought.
And HBM4 is a paradigm shift. It requires a massive 2048-bit interface.
Double the width of HBM3. And critically, it needs a custom logic die at the base of the stack to handle that interface.
And this is where Samsung's unique turnkey capability comes into play.
Exactly. They are the only major player with memory, advanced logic foundry, and packaging all under one roof. They can design that custom logic die themselves, stack their own memory on top, and package it all in-house.
And they're leveraging that to make a very specific technical bet on how to win.
A high-risk, high-reward bet. Hybrid bonding, or HCB.
Instead of using those tiny solder balls to connect the dies, they're fusing copper interconnects directly. Why is that so risky?
The risk is yield. Hybrid bonding requires near-perfect alignment and flawless cleanliness. It is notoriously difficult to get right in mass volume. Execution here in 2026 is arguably the single most important technical milestone for the company's future.
And the reward.
Superior thermal performance, better signal integrity, and greater density. If they perfect HCB, it offers a real...
The potential payoff looks immense. Reports suggest they're in final negotiations with NVIDIA for the upcoming Rubin architecture,
with potential volume allocations exceeding 30%. If they achieve that, it definitively eliminates that AI lag discount they've been trading under. It transforms the market's perception.
Okay, let's pivot to the second, and maybe even more crucial, battleground, the foundry. It's supposed to be their growth engine, but it's been a massive financial drag.
A huge drag. The foundry has been posting operating losses of 1 to 2 trillion per quarter. The history here is painful. They were the first to implement gate-all-around, or GAA, transistors at 3 nanometer.
A technological lead.
But they couldn't execute. The yields were cripplingly low, reportedly below 20%.
So Q4 2025 marked the financial turning point, with losses finally narrowing.
Yes, under 1 trillion, and the goal is to hit break-even by late 2026. This turnaround is being fueled by stabilization at the next node.
Which brings us to the 2-nanometer SF2 opportunity. What are the reports telling us about yields there?
This is genuinely encouraging. Unlike the 3-nanometer disaster, the 2-nanometer GAA process appears to be stabilizing much better. Reports indicate yields have reached the 50 to 60% range.
50 to 60%.
Yeah.
That might not sound perfect, but in advanced manufacturing, that's considered viable for mass production.
It is. It's a massive psychological and technical step up from sub 20%. And this progress is immediately translating into commercial traction.
Starting with Qualcomm.
Qualcomm, which has relied almost exclusively on TSMC recently, is confirmed to be in active discussions to dual-source 2-nanometer chips from Samsung.
Which isn't just about price, it's strategic for Qualcomm.
It's all about supply chain risk mitigation. The industry simply cannot rely on a single geographically vulnerable source like TSMC anymore. Samsung is the only viable alternative at that bleeding edge.
And then there's the massive landmark win that secures future volume. Tesla.
A landmark $16.5 billion contract to manufacture Tesla's next-gen AI6 inference chips on the 2-nanometer node.
For their autonomous driving fleets.
For their future fleets, yes. Production is slated for 2027-2028. This deal is transformative because it provides the guaranteed massive volume visibility Samsung needs to fill up its new fabs.
And speaking of fabs, the U.S. strategy is tied directly to this.
The Taylor, Texas fab, a $17 billion plus investment, is now targeted for mass production in 2026. This timing aligns perfectly with the 2-nanometer maturity and the ramp-up of U.S. client orders like Tesla,
A geopolitical hedge.
a crucial one. It ensures they have capacity close to key North American clients who demand geographically diversified supply.
And before we move on, what are the big R&D bets they're making for the future?
Two crucial ones. First, BSPDN, or Backside Power Delivery Network, for the 2-nanometer node.
Routing power from the back of the wafer.
Exactly. It frees up space on the front, dramatically improving transistor density and efficiency. It's a massive architectural shift, vital for challenging TSMC.
And the second bet.
It's changing the foundation of the chip packaging itself, the accelerated development of glass substrates.
Instead of organic materials.
Right. Glass offers superior flatness and thermal stability, which is vital for building those huge, complex AI chipsets. Samsung is pushing for mass production by 2026, aiming to gain a packaging edge over everyone.
We've spent most of our time on the chip division, and rightfully so. But Samsung is this sprawling conglomerate. We have to look at the massive mobile business, which is their perpetual liquidity provider, and the critical issue of corporate governance.
Right. The Device Experience Division, particularly Mobile Experience, or MX, is the corporate cash cow. When the semiconductor cycle goes south, like it did in 2023, the steady revenue from phones keeps the lights on and funds that massive R&D budget.
And as of late 2025, they were still the leader in global smartphone shipments. But their strategy has shifted. It's no longer just about the camera. It's all about the AI phone.
Yes. Differentiation today relies almost entirely on software and on-device processing. Their Galaxy AI features like real-time translation during calls or generative photo editing are designed to drive consumer upgrades.
But the mobile division took a major, painful hit in 2025. Analysts called it the application processor tax.
It was excruciating because it was self-inflicted. Their planned 3nm Exynos 2500 processor, which they wanted to use in the Galaxy S25, suffered those catastrophic yield issues we just talked about.
So they were forced to use expensive Qualcomm Snapdragon chips everywhere.
Globally. And since Qualcomm is the dominant supplier, they charge a premium.
Qualcomm basically had them over a barrel.
They did. That dramatically increased procurement costs and squeezed the MX division's profitability. Its operating margins likely dropped by several percentage points.
But they are preparing to restore their advantage.
The future looks much better, tied to the chip turnaround. The next-gen Exynos 2600, built on that stabilizing 2nm node, is showing promising performance.
So they can bring back the dual sourcing strategy for the Galaxy S26 in 2026.
Exactly. If they can build a competitive chip in-house with their own foundry, they control the cost and maximize profits.
And speaking of premium, they have to maintain the innovation narrative in folding phones.
That's the innovation race. They're reportedly preparing the Galaxy Z Trifold, a dual-hinge device, for 2026. This aggressive push is critical for maintaining high prices and brand prestige against rivals like Huawei and Honor.
Let's quickly touch on the other pieces of the conglomerate.
Harman, the automotive and audio division, is a quiet, stable growth engine. It consistently contributes about $500 billion per quarter, mostly from digital cockpit systems and car audio.
A low volatility asset. And then there are the classic low margin divisions.
Visual display and digital appliances, TVs, refrigerators, they hover near break-even.
And they're trying to revitalize them with the AI home concept.
Right, focusing on smart things connectivity. It won't drive huge profit growth, but it's strategically vital because it increases ecosystem stickiness, making it harder for a consumer to leave the Samsung ecosystem.
Now we turn to the elephant in the room that has plagued Samsung's valuation for decades. Governance and the Korea discount.
This is crucial for any sophisticated investor. The Korea discount is why South Korean firms, including Samsung, consistently trade at much lower valuation multiples than their global peers.
Lower PE ratios, lower price to book.
Exactly. Compared to TSMC or Apple, it's a huge gap.
And why is that? What does opaque governance really mean?
It stems from the complex, circular cross-shareholding structures typical of cables, the family-run conglomerates, and historically, management has favored reinvesting cash or hoarding it, not returning it to minority shareholders.
A perception that the duty is to the founding family, not pure shareholder value.
That's the core of it, and that lack of transparency and low payouts depress the stock multiple, but they are under immense pressure to address this now.
So what are they doing?
Well, they have a fixed annual dividend commitment of 9.8 trillion won, and they have formally committed to returning 50% of any free cash flow above that to shareholders.
And the recent buyback announcement in January 2026.
The 2.5 trillion KRW share buyback is a positive signal. And crucially, they're using those repurchased shares for employee compensation instead of just issuing new ones, which avoids diluting shareholders.
A good step, but not the final step.
No, investors want the outright cancellation of those treasury shares to permanently boost EPS. And the government is also applying pressure through its corporate value-up program.
What's that?
It's a government initiative to force large firms to tackle the Korea discount. Market expectations are extremely high for Samsung to release a detailed roadmap under this program in the first half of 2026.
And if that includes a commitment to cancel those treasury shares,
It could trigger a significant and permanent re-rating of the stock, a critical, non-technical catalyst that investors are watching very, very closely.
okay, let's put it all together. The sources lay out a very clear bull case and a very clear bear case, a perfect risk-reward profile for you, the listener, to consider. Let's start with the optimistic view. Why are the bulls calling for growth beyond this 20 trillion won peak?
The core of the bull case is the earnings explosion. The argument is that 20 trillion is a plateau, not a peak.
A new baseline.
A new baseline. Structural shortages in commodity memory, driven by that HBM capacity cannibalization, will sustain high prices through 2026. If they can maintain this leverage, annual operating profit is projected to move toward the astronomical figure of 100 trillion KRW.
100 trillion.
Unprecedented cash generation.
Okay, second bull point, HBM validation.
They need to prove they are a strategic AI partner. Even modest success, like securing a 30% share in NVIDIA's HBM4 orders, would be a monumental validation of their risky hybrid bonding tech.
It would kill the AI lag discount.
Instantly. And finally, the foundry transformation. The progress at 2 nanometers, the GAA yield stabilization, and the commercial wins like Tesla and Qualcomm, it transforms the foundry from a cash incinerator to a genuine high-margin growth engine.
So if all three of those click, the market is severely undervaluing them.
That's the bull thesis.
But every massive industrial story has significant risk.
Yeah.
What keeps the bears up at night?
It all boils down to execution risks. The memory recovery is baked in, but the real upside depends entirely on them mastering highly difficult new technology.
Right.
If HBM4 hybrid bonding fails to yield in mass volume, or if the 2-nanometer bridge GAA process falters again like 3-nanometer did, Samsung misses another crucial cycle.
And they risk being permanently relegated to a secondary player in advanced logic.
Ceding the entire high-growth, high-margin market to TSMC.
And the second risk relates to the very thing driving the earnings today.
Demand destruction. It's a classic cyclical risk. Memory prices rose 40 to 50% in one quarter. If they get too expensive, that eventually crushes demand in high-volume sectors like PCs and smartphones.
The cure for high prices is high prices.
Always. And AI demand alone can't offset a total collapse in consumer volume.
But the third major risk is entirely geopolitical.
Yes, the U.S. regulatory shift regarding their massive Xianan fab in China is a perpetual cloud. That facility produces a huge chunk of their global NAND output.
And the U.S. government shifted from an indefinite export status to an annual renewal.
Which creates perpetual regulatory risk. It caps the tech ceiling of their China operations and forces them to spend heavily to build expensive capacity elsewhere, like in Texas.
But regardless of those risks, Samsung has a safety net that others don't.
They do. They're moat. The barriers to entry in this industry are astronomical. We're talking 50 trillion won in annual capex just to stay relevant. It's an unassailable oligopoly.
And the fortress balance sheet is their strategic weapon.
Their net cash position, consistently over 100 trillion KRW, ensures near zero chance of failure. And more importantly, it lets them weather downturns without the fatal mistake of cutting R&D. They can afford to absorb the foundry losses while waiting for 2 nanometers to mature. That cash is strategic leverage.
So let's bring this to a head and summarize the key takeaway for you, the listener. Samsung Electronics in Q1 2026 presents a classic asymmetric bet. The earnings floor is protected by that commodity memory supercycle.
That's the guaranteed cash flow, the insurance policy.
But the massive multi-year upside depends entirely on flawless technical execution in those high-stakes HBM and foundry segments. They have to stick the landing on 2-nanometer GAA and HBM4 hybrid bonding.
And that successful execution brings us to a final, provocative thought that management, investors, and analysts are all wrestling with right now.
Okay.
Considering the company's historical priority of maintaining that fortress balance sheet, and given the massive 30 to 40 trillion won of free cash flow expected in 2026, Where should their primary strategic focus truly lie?
The core strategic tension.
Precisely. Should management continue to prioritize the massive, loss-incurring, but strategically vital logic foundry business, essentially buying long-term growth optionality to hedge against TSMC? Or should they refocus capital entirely on their world-leading cash-generating memory and advanced packaging divisions and use that overwhelming 2026 cash flow to permanently resolve the Korea discount through aggressive share cancellation, as value investors are demanding? This choice growth optionality versus pure, immediate shareholder return is the core strategic tension, and the answer will define Samsung's valuation trajectory for the rest of this decade.